Hi, it's Phil. Welcome to the Anti-Investor Swing Trading Podcast, where we talk about swing trading stocks, stock options, and index futures. My goal is to help the next 1,000 traders become financially independent and retire early from the financial markets by providing the right tools to use, the rules to follow, and the software to assist you so that you don't make the same mistakes that I made. And from now on, I'll be your personal swing trading mentor to show you the way. So if you're ready, let's do this. I'm going to be breaking down my number one trading strategy, which is what I refer to as production line trading. This is a simple rule-based system that is proven, profitable, and repeatable and takes just 30 minutes a day, a few times per week. You may have heard the phrase buy the dip, and what I'm going to show you is to find a buyable dip in the context of an uptrend, and it's adding that extra layer of detail onto the phrase that is going to help define what you're doing, when you're doing it, and why you're doing it. And it allows me to go into more defined and rigid rules so that we can find a dip worth buying. It's backed by irrefutable data, and if you're watching this on the visuals version of this podcast, then you'll be able to see some of the charts and data and reports that we can quite literally, at the click of a button, spit out to demonstrate that we have a positive expectancy strategy that is driven by actual historical data. And it's rules that allows me to do this. Again, if this, then that type rules that allows me to find, filter, and sort opportunities. And I wanted this for myself first. Again, I don't want to flick through chart after chart after chart like a mindless zombie, hoping that the next one is the one. I want to be able to go, there's the trade. And where most people, most traders, new or experienced for that matter, can spend hours looking at charts, drawing trend lines, adding and removing hundreds, if not thousands of indicators, changing settings, timeframes, doing adding the Dow theory, the Gann theory, the Elliott wave theory, and all the other minutiae of tools that are available to us, or the purpose of asking the question, where's the trade? And wouldn't it just be a simpler and easier way to trade if we could just have a clear-cut set of simple rules that changes the question from where's the trade to making it a statement? There's the trade right there, because that's what I want for me in my own trading first and foremost. And it's getting clarity and getting definition and using rules backed by data that allows me to do that. So without further ado, let's jump into those rules so that you've got exactly the same rules that I'm using every single day and the same rules that I teach all of my students to use. First thing I'm going to do is I'm going to dispel the multiple time frame analysis. You don't need to use multiple drop-down analysis. Again, at the click of a button, we can spit out reports that says this time frame, this strategy is profitable on this group of instruments. So I'm going to use a daily chart. That's my preference. If you want to use speed things up or slow things down, to use the production line factory metaphor, you can speed that production line up or slow it down. That just means change the time frame. I like to daily charts. I don't want to be sat at the computer all day, every day. I did that for 12 years when I was a day trader. I don't find it pleasurable anymore. So I want to do it on a daily chart. I want to glance down, for example, my top 25 stocks, and I want to go, oh, there's the trade for that stock today, and place the trade, and then go and do something else with my day. And that's what I want to do. Maybe you're a little bit more busy. You've got a busier lifestyle. You've got the day job. You've got family commitments, work commitments. It allows you to just check in, check for trades and check outs on a daily chart. And if you have a bit more time, you've got a bit more time flexibility to look at things through the day, you can speed things up, turn the dial down, change the time frame, and speed that production line up so that you can get paid at the end of the week, for example, on a 60-minute chart. And if you want to get paid at the end of the day or by lunchtime, then you can go down to a 2 or a 5-minute chart. Again, because it's an algorithm, I can validate the time frame and the instrument that I'm trading. Again, if you're watching this on the visuals, you'll be able to see a report that says if I've done this for the last 6 months, 8 months, 12 months, and the last 20 years on a daily chart, I can quite literally have a report handed to me using the rules that I'm about to explain to you that says, yes, this chart, this instrument, this time frame was profitable. And that gives me the confidence to place the trade without discretion, without second guessing, without thinking a great deal about it, to just basically put the trade on. Because one of the key elements of any strategy is consistency. I want to trade this chart, this instrument, this time frame with consistency, because I don't know any more than the next person which opportunity will work, whether the next 5 will, whether the next 5 won't. So what I've got to do is I've got to trade. Again, I trade a small universe of stocks, so I don't have that FOMO. I have my 25 favorites. You can have a top 50, a top 75, top 100. I have a master universe of stocks that I can draw from, but I'm basically focusing on at least the top 25 stocks. I give all my students, the choice of those stocks as well, so that you've got your 25 stocks. So it makes it manageable. Again, we're not looking at every chart every day all the time. I just want to look at, hey, these are my favorites, my top 25, which of these stocks today, if any, have presented a trading opportunity. And at the click of a button, I can have a report say, yes, in the last 20 years, this has been consistently profitable. Therefore, if I trade that stock or that group of stocks for the next 12 months, I've got an average expectancy over multiple occurrences that I should be able to turn a profit. Just like any other business in the world, whether we had a bricks and mortar business, it's no different in the trading world. We want to open the shop up from 9 to 5 and trade the opportunities that we have the customers come in with the consistency and the frequency that they come to the shop. Trading world is no different. Our customers, our trades, our opportunities are the setups. I'm going to look for those setups in a production line fashion so that I've got the consistency and trade them with the frequency that they set up, that the market provides for me. So I'm going to trade a daily chart. That's my preference. My aim is to get paid at the end of the month, at the end of 30, 60 or 90 days with a daily chart. That's typically the average. My own average time of trade is about 30 to 45 days, sometimes a little bit faster, sometimes a little bit longer, but that is what I'm aiming. That's why I'm using a daily chart. It allows me to check in, check for trades and check out. The other thing I'm going to do is I'm going to use a moving average, one indicator. So I've got one time frame, one indicator. It's a simple moving average. I'm going to have that 3 times on the chart. So I've got a 200 period moving average, 50 period moving average, and a 20 period moving average. Again, there is nothing magical about the moving average. What it allows me to do is apply a consistent, structured framework to evaluate where price is in relation to the tool that I'm using. Again, when I explain the rules to you, we can all confidently say that price is either above or below one or all of the moving averages, and I can say if it's above them or between them or between or below them. We can all agree that price has made a movement above the 200, the 50 and the 20 period moving average. We can all agree that that is a statement of fact. So there's no subjectivity involved at its most basic level. We're not interpreting discretionary patterns, the Dow theories, the Gann theories, the Elliott wave theories, the multitude of fractal patterns that there are out there. There's no interpretation. We're making a statement. Price is above the 200. Great, check. Price is above the 50. Check. Great. Price is above the 20 period moving averages. Above all 3 moving averages. Great. It's probably in a bullish uptrend. So therefore, I will be looking for buying opportunities. We can all make that statement. That's why we're doing it. So first thing we're doing, daily charts. Second thing we're doing is adding a moving average. And what I'm going to look for specifically to help me determine, well, should I be looking for bullish trades or bearish trades? I'm going to look for the 50 period moving average to be crossed above the 200 for bullish trades and just the opposite for bearish trades. It's not an automatic, I'm gagging on the phrase buy indication when price is crossed above the 200 or the 50 is crossed above the 200. It just gives me a directional bias. One of the downsides to using any indicator is that they do lag. So to help avoid some of the false starts, whipstores that are inherent with any indicator, I'm going to wait 20 periods, 20 days in this case. So wait for the crossover and wait for 20 days. And that is going to help me avoid those false starts. They're the 2 conditions that is going to give me a directional bias and a green light on when to go and start looking for entry opportunities. So the third part is we're going to look for those entry opportunities. We've got a directional bias. I'm looking for bullish trades. At that point, price should be pushing upwards. I'm then going to wait for price to pull down, pull back, retrace. I'm using lots of different words to describe the same thing. but retrace back between or below the 20 and or the 50 period moving average. I'll just talk in terms of the 20 period moving average for simplicity, but it could be one or the other. But just for simplicity, I'm going to reference just one as I'm describing this. And again, there are visuals to accompany this walkthrough guide of the production line training. If you'd want to know how to gain access to it, just simply send me an email, phil@antivesta.com, or hit reply on any of the emails that you receive from me, and I'll show you how to get access, basically. Anyway, so we've got one time frame, one indicator. We're waiting for price to push in one direction, and then we're waiting for price to retrace. So the third rule is to wait for price to pull back to at least the 20 period moving average. And at that point, we can quite confidently say price is in a bullish mechanical direction, and price has retraced to the 20 period moving average. Notice how I'm saying this. It's a statement of fact. It has happened. So when that happens, that makes it a dip worth buying. I can ignore the rallies and the retracements that are above all of the moving averages, but I'm going to pay special attention to the first time that price comes back to the 20 period moving average. At that point, I'm going to sit up and go, you know what, this is a dip that is worth buying. Now, it's still not an automatic buy indication for me. I'm moving that stock, that particular stock, out of the 25 stocks that I'm already looking at. I'm going to move that stock one step closer or further along the production line. Those 25 stocks, the raw materials of the production line, I'm now starting to fabricate a trading setup. I'm going to move it one step along the production line. Say, okay, now this is a buyable dip. I'm now waiting for price to go from below the 20 period moving average to back above. And that could be a few days, it could be a week or so. It might never go back above. It might, go the opposite way and start downtrending. We'll find out. But when it goes back from below the 20 period moving average, back above the 20 period moving average, so from below to back above, we're back above all three moving averages, back in an uptrend. That's the point where it becomes a dip worth buying. I'm going to move that stock one step further along the production line. And now I've got a trade, I've got a live one. I've got a completed entry trade. So that trade has now gone live. I've gone from raw materials to finding a buyable dip, and then it becomes a dip worth buying. So it's now further along that production line as price goes back above the moving average. At that point, I'll have my entry. I've got predetermined stops and targets. There's a little bit of math involved. It's just basic addition and subtraction. I've got a formula. It's a little bit beyond this audio recording right now. Again, if you'd like access to the training program that comes along with this back of the envelope description, shoot me a message, and I'll show you how to get access to that program that describes everything. But we've got a very simple calculation that says, hey, here's my stop loss, here's my targets, and what if it doesn't get to targets? What if it starts moving favorably but doesn't get all the way to where we think it's going? Then we've got some trade management rules. So we know where we're getting in, where we're getting out, and more importantly, what we're going to do if it doesn't do what we think it's going to do. So we've got a live trade at this point. Before the trade goes live, I know my entries, exits, stops, and targets, which is going to give me confidence. I know exactly what I'm going to do, when I'm going to do it, why I'm going to do it. And there's conditions for all of those things. So at that point, I'm now onto the management track, the management production line. Has the management rules, or have the stop loss been hit? Has the target been hit? Has the management rules been hit? If no, come back tomorrow. If yes, manage the trade. So it's now a very simple production line process, a checklist, just like a pilot has a pre-flight checklist. We're going to flick the knobs, twiddle the dials, we're going to check the checklist, check the box, and make sure that we're applying the rules with consistency and methodically, so that we can have the opportunity that the markets present to us. And that's quite literally it. It's a very simple process. And again, appreciate for audio. This is just the back of the envelope version. There are more definition, more robust set of rules that comes along with this loose description of what I'm doing. But this is the process that I'm using. Determine a direction. Make sure that price is moving in that direction. bullish, and then look for a dip worth buying, find a buyable dip, then place your entries, exits, stops, and targets, and wait for one of those things to happen. If the stop loss is hit, close the trade. If the target's hit, close the trade. If the management rules hit, close the trade. It's a very simple process. And it gives me a lot of peace of mind to know exactly what I'm doing, when I'm doing it, and why I'm doing it. Again, as always, I want this for me first. It keeps me sane. It's certainly been working very well for me for the last 28 years. And I'm sure it will continue to work for a long time into the future. This is the process that I refer to as production line trading. If you would like to know a little bit more about it, more structure on the rules, again, send me a message, phil@antivestor.com. I'll show you how you can get access to the training course or any of the open house workshops that I've done to explain this with the visual version of the strategy walkthrough. And that was, again, the production line trading process. This was the very first episode of the Anti-Investor Swing Trading Podcast. Hope you've enjoyed it. Tune in at the same time, same place next week for more information on how to swing trade the stock markets. Until then, toodaloo, ta-ra, pip pip, and I'll see you all next time. Keep in mind that futures, options on futures, stocks and stock option trading involves a degree of risk that may not be suitable for all investors. Past performance is no guarantee of future performance. Anti-Investor provides educational information and does not provide financial advice.